The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls now, toll free at 1-877-927-6648. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. The first thing that I posted into Tiger TV today is a letter that went out to most of the traders at the CME. It's from the CME group, and it's you have a chance, you should read it, because what it's doing is it's telling people that the this sequestration that's coming, in other words, these federal spending cuts that are supposed to start on March 1st, 2013, are going to affect our markets a great deal. They're talking about the basically cattle, hogs, and feeder cattle in this particular one, but will also affect our grains, because they have to be inspected for shipments and stuff like that too. So they're cutting back, personnel. This means that the data coming through on the USDA reports might be late. And then again, if they have too many people cut back, how long will they be delayed, and if they will be correct or not? So these are factors that we're going to have to work through. We'll wait and see, what happens. But at least they're sending a warning letter out, to tell people, that that's what they're really looking at. Now, I wanted to start the show because it's a commodity show, but I wanted to show you what has been happening at the Hang Seng Index in Hong Kong, because we had the Chinese New Year, and the market was completing a beautiful ABCD Gartley. And if you look at it really closely, you can see that from low to low and low to high was exactly 8 months in time, and the price was exactly correct. And since that time, the price of the Hang Seng has fallen sharply, well over 1,000 points, and it's done it with some real serious gaps. And so that's telling you that this market probably has made a major correction, and it could be affecting us in the U.S. But frankly, the way the U.S. market is acting with the big move down yesterday and the lack of rally today tells us that might be the case for sure. Now, of course, there's nothing for sure that we know for without any argument that there's nothing that is for sure. Now, I wanted to go back to the part about the cattle, because the cattle, hogs, and the bellies, because we've been looking at the cattle market really closely here for the past year or so. When we had the big butterfly top that occurred way back in December, and the market has broken well over 10%, and we went down to the 61% retracement and had a very strong rally. And then the market came down and expanded to the 786 and 1.618 level. And what it's doing now is it's double testing that 1.618 expansion level one more time. So, cattle have been under, a serious amount of pressure here. And remember that all of the commodities that we're looking at have been, under serious what we call distribution. And this distribution has finally, really taken its toll. The next chart that I'm going to put into Tiger TV shows the ETF for commodities known as the DBC. And as you can see, yesterday we were talking about the 61% retracement and the wide-ranging bar down into that level, and the fact that it stopped right at that spot. And then today, we leave a big gap down, and of course part of that was due to the gold and silver collapse. But most everything has been going down. So as you can see, the red line is the stock market, and it has held up relatively well given the commodities, but the rest of it is not done very well at all. So this is what we have going right now in the commodity market, and that's what we're looking at least for these commodities, because we've been warning you of the divergence between these for quite some time. Whether it's going to get any worse or not, we'll have to wait and see. The main one that that we talked about for a long time, going back several weeks ago, of course, was the copper, and that was when we had these rising wedge patterns, like the one we had in June and July of 2011, and then we had one here in January and February of 2013. And you can see when they broke these rising wedges, they broke very, very dramatically, and we're down, well over 15 cents in copper in just a matter of a week or two, and that's a tremendous amount of movement, because that's well over $3,000. So these are things that we're watching. The questions you have to ask yourself if you're in the stock market, and remember, copper is in almost anything electronic that is built because of its conductivity. And why is it that the copper has made lower highs for 2.5 years, and we've had this big bull market in stocks? And the answer to that is the stock market is not the economy. The stock market is a market for stocks. And so just remember that we've not had a divergence like this, in not in my lifetime that I can remember, where copper didn't have a very high correlation, with the stock market, and that has not occurred this time. Now we hear stories about China and all the things that are going on over there, but frankly, I mean, China is a large part of copper, but it's not all of copper. The rest of the world is copper too. So Europe is having trouble, South America is having trouble, and whether we're having trouble or not, we'll have to wait and see. But these commodities, if they were really good, would really be moving, far, far better, in my opinion, to see that we had a, much better movement for these things. Now, I want to focus here on silver today, because and also gold, because I think we're heading lower in the silver and also in the gold. We'll start with silver first. We have a 786 retracement coming in, about another 70 or 80 cents lower, coming in at around 27.80 per ounce, and that should be a pretty good bottom, because you have two ABCD patterns there. You have a 786 retracement. You'll have a 1.414 expansion, so you'll have many things that are occurring at that time, and you'll be able to see if it's going to be a low-risk trade or not. But frankly, it's coming down so fast, it could just really accelerate through here. I mean, it's very, very oversold. We had a $30 rally in gold, overnight, and it's still down on the day. So that's all it was just a minor short covering rally, much like we had in the S&P early this morning. Someone asked me a question before the show started, what would be the key level to watch in the S&P, and I believe it's somewhere around that 1480 level. Remember, this whole thing started really on the 2nd of January, when the market, gapped up 20 points. And that's a gap that's going to be filled. That gap is at 1420 in the S&P, and, we're still at 1500. So we're 80 points, away from that gap. And, if we can give back 35 points in one day, in just a matter of a few days, you could be back into that gap area, and then you could have a situation where that gap will be filled. So that'll be for another day of what we're watching, but we'll keep an eye on that. The next one, I want to move into the gold market, because we have so many people that have a really strong interest in the gold. And what we'll do is we will look at the weekly chart in gold, because I believe this is where we will be going sometime in the next several months, probably out into May sometime, and that is down into this 1365 level is what the long-term price of the gold is. Now, gold moves around a lot. So if you go to your hourly charts or your half-hour charts and things like that, you'll be able to, find good entry points, that will allow you to get in and, without risking an arm and a leg. And that's the whole premise of, you can make a prediction. You think that, you're going to drop $240 an ounce here at gold, but the question is, where do you get in? Do you sell it here where it's trading at $1,580 and then, just risk $150? Well, of course not. You've got to try to enter a market, where you've got a chance where it will not be, too hard to enter. And so what I want to do is we're going to take off, switch gears here for a minute because we're at such a critical point now in the price of the stock of Apple. And I would like to show you how I look at, setting up a potential low-risk trade. And we have the price of Apple is now approaching the $443 per share level. And I was going to say per barrel, but it's per share. And if we go below, that 14, say 37 level, this is going to set up our original target of $394 an ounce, because that will make a very large ABCD pattern complete at that point, and that will be where we will be heading. So I will put that in, and you'll be able to see that it's very, very close to that. I'll put the big ABCD into the Tiger TV, and you'll be able to see it. I'm probably putting in too many charts today, but all I wanted to do with this one is to show you, how to set up a low-risk trade, because, Apple trades very wildly, and, we had the Gartley pattern form up at the 484 per share, and then, for the last 5 or 6 days, 7 days, it's come down, and now it's touched the 786. So it's at the moment of truth here. If Apple starts to break much below 440 per share, it's very, very close to the 394 level, which has been our very long-term objective in that. So that's just how, I try to use the charts going from your daily to your 60-minute, to get an entry point where you really don't have to, to risk, too much at all. That's the real beauty of being able to switch between time frames. Now, years ago when we traded on the floor, we didn't have that, particular advantage to be able to, to do that. But we do have some. After we're going to have a short break here, I think, pretty soon, and after the break, we have to take a look, and we'll spend the remainder of the time looking at our notes and bonds, because we came off of the 61% retracement, and we'll take the break here and pay a few bills. 877-927-6648 if you have any questions.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks. And what I'm going to do is post the chart for the Treasury notes, which are the shorter term. They go out, 5 to 10 years. And what we're going to look at is on the red line will be the U.S. Treasury bonds overlaid upon the Treasury notes. And you notice that they have almost 100, well, they do have 100% correlation other than the degree sometimes, but they go up and down together because they're the interest rates, that everybody, uses for their cars, their appliances, and, their mortgages and all of this. But the really important thing is that we've hit the 61% retracement in the U.S. Treasury bond 30-year at that 142.05 level. It hit it absolutely perfectly, and I will post that into Tiger TV. And this is a really incredible chart because it shows the very large ABCD pattern that stopped exactly at the 61% retracement. And this could be the last rally. This is my opinion, of course. This could be the last rally that takes us, higher here. Whether we make one more new high or not will probably depend if we get a really large sell-off in the stock market, and there'll be one more, flight to quality. But this is, I believe, the best trade, that we could have for a long term, because it's been a 31-year bull market. In other words, interest rates have been dropping for 31 years. We've completed a pattern that's taken, well over 5 months to complete. It stopped right at the exact 61% retracement, which should be no surprise to anyone because it's a very large, spot to take a look at, where we are. And if we can get a rally up into this 148 level, that would be good. We've rallied 2 points in a matter of, just a couple of days here. So it's possible that if it does start to, stocks start to move lower, then we could be, moving down. Basil mentioned on his show, the fact that the VIX jumped so much, in one day, and we've been talking about that for quite some time because, even though the VIX was at 1929 depression lows and it dropped, I think 39% in 1 week, then this is what the volatility index does. It tells people that the market is not as complacent as it looks like, and there is fear and greed in the markets at all time. And now we're seeing the fear part, come out. The fact that it jumped up this much in 1 day should not be surprising because it came down so hard. So it will probably have to do some backing and filling in here, but we'll wait and see, what will happen. Now, there's always a possibility that there's an outlier event that could happen that changes things. It could be this thing that's happening in March where they have the sequestration, where we're cutting back, on all kinds of spending. That means people could be losing their jobs and, cutting back everywhere. And, we'll see, if this will be it, or it could be something from Europe. It could be a, China-Korean conflict. It could be anything. I mean, anything could cause, the market to do it. The fact that it's way up here, and I've been saying this for, weeks and weeks and weeks. Markets that go straight up, that's how they come down. That's Isaac Newton's, second law of motion. What goes up must come down. So, this is what, this is what we're looking at. Anyway, this is what we'll be watching are these Treasury bonds. And the price level that we're looking for is if we could make a 61% retracement, which would take us up to about another 4 points higher from where we are right now, up into this 147 level. And if it could do it, over a period of 4 or 5 weeks would really be nice, because then you would have a nice ABCD Gartley pattern setting up, and then you would also be looking at a head and shoulders pattern on the Treasury bonds that would be well over a year and a half in the making. And if you remember, we had one of those in the NASDAQ recently, and it certainly has, shown that, yep, that head and shoulders pattern, is working, and it's working, quite a bit. So that's it. Someone asked me to say something else about Apple. There's nothing else to say. If Apple goes below the 440 level, you'll be looking at, I think you're going to be going down to that 394. It's got it written it all over. It's trading at 444 now, and it needs to get below 440. The 786 is 443, so it has some support here. But if Apple breaks, we've been looking at Apple, for a long, long time at 394. And it can certainly make that. Realize, folks, it's only 5% away. It's 10% away. Excuse me. Anyway, we've got to take a little break here. We'll be back after the break, and we'll be covering some of the grains.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91. And only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com. Now, back to the Futures Hour.
Okay, we're back, folks, and we're going to take a look at the grain markets now, and I think what we'll do is we'll start with the strongest one, which is the soybean market. Going back well over a year, you can see the ABCD pattern that led to the top. You can also see the nice Gartley that formed, right before the big part of the drought in June. But the important part about this chart is the fact that from December through July and then down into December of this year, that one-year cycle, it stopped exactly at the 61% retracement, to the exact penny. And then we had two equal rallies. One happened in November, the other one happened in January. And then we talked about this last week. The market came down and it stopped exactly at the 61% retracement in the soybeans at the 1407 per bushel level, and now has it actually gapped up 3 days ago because of some Chinese buying, and the market now appears, that it's ready to break out above this $15 level. So the soybeans are by far the strongest of the three grains that we look at, which are soybeans, wheat, and corn. Those are the ones that we look at, the very, very closest here at TFNN. So we want to watch that. Each time we would do the show, we try to look at that. The next one we're going to look at is really interesting because we are at a very, very important time now, because we are like we were in soybeans 2.5 weeks ago. We are here in wheat right now. Wheat is trading at $7.22 a bushel, and at $7.17 a bushel, 4 cents lower than where it is now, is the 61% retracement. And as you can see, there's a little, Gartley pattern there, and it makes it very difficult to not look at this because it's a very, very pretty picture, and it's not going to take very much, risk here, because if it doesn't stop at the 717 level, you only have to risk 10 cents at the most, which is $500. So you become a farmer for $500. You control a couple hundred acres of wheat, and you don't have to worry about the seed. You don't have to worry about the weather. You don't have to worry about your farm equipment and everything, because you're just holding it in a contract form. So you'll own 5,000 bushels of wheat at $7.17, and that amounts to about $35,000. So you become a farmer for $35,000, and you need to put up about $2,000 in margin for that. So you become a full-fledged Iowa farmer, or Kansas farmer, in this case, for the small price of $2,000. And the profit on this particular trade, we don't know, of course, what the market will give us, but if it rallied like it has done the last few times, will be at least $2,500. So that would be, doubling, your margin, and it would also be 4 times your risk, which is a very good risk-reward ratio. So this particular chart in wheat, we will be following, on next week's show, and probably even on Monday's show, if it either fails or works, we should be watching it, because this is at the moment of truth. I mean, this is what you wait for. I mean, we've been waiting for this price to come down here for a long time, and it's very, very close. We're within 4 cents, and that's nothing. And that's a heartbeat. That could be, in a matter of a few minutes. But you can see the nice patterns that are in wheat, and the fact that it holds up, extremely well with the numbers, and that makes it, very, 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 very good. Now, I'm going to bring up the next one, which is corn, and because we have a very interesting situation on a shorter-term basis in corn. We'll take a look at it here, looking at March corn going back a couple of months, and we are reaching a level that is very important. It's at higher bottoms that we look at all the time. And I will put this, I've got to draw the pattern in because it's such a pretty little Gartley pattern that I want you to see it, and you'll see that we have some higher bottoms coming in corn. So what we've got now is we've got soybeans very, very strong. We've got corn, the weakest of the group, and then also we have wheat that is very strong. They're all at the moment of truth. In other words, so we have wheat, corn, ready to turn if they're going to, because you don't have to risk very much at this particular level. And we have soybeans already moving. So soybeans have moved well over $3,000 a contract away from the 61% retracement, yet we haven't had that happen in the corn and the wheat yet. So that happens all the time. They don't always run in unison, but they do follow the numbers, pretty good. So you can be looking at this one particular chart that I posted is March corn, and it does hold up, relatively well. If we switch to a daily, you'll see that we are in the same situation where we've stopped at the 786 retracement in this corn for the past 8 or 9 days. So we're at a very, very critical level in all of these, and the markets are oversold. The patterns are there. I mean, these are low-risk trades, in my opinion, especially in the wheat and corn. Not so much beans because they've already moved. They've had a tremendous move off of this, but the wheat and the corn are certainly in levels where you want to be looking to be a buyer if you believe in these numbers. Now, this has nothing to do with the fundamentals. We're just looking at what the other people are buying and selling. And, it's better to buy when prices are down and it's cheap, so you don't have to worry about the amount of money that you have to risk, because if you're buying a breakout, you're going to have to, risk an awful lot. If you're buying into a correction and use a pretty good stop, then you'll be able to, have a pretty good indication that you don't have to risk very much. And on this particular trade, you don't have to risk more than about $250 would be the opinion that I'm looking at. Someone asked me to change the subject here for a little bit, which I will, and I'll get back to it in just a second. But I wanted to bring out the XAU. That's the gold silver index. And, this is one of the things that has been incredibly bearish, all along in the metal markets. And when we've had these rallies, we've watched this go down. And with stocks as bad as they are, the XAU was even worse. Excuse me, I said that wrong. With stocks as good as they are, no one was buying gold and silver stocks. So the people that producing that stuff must know something more than what we know. That's the bottom line. Now, this was the daily chart of the XAU, and if you go to a weekly chart, you can see that the weekly chart does have some type of a pattern forming that is quite interesting. I need to change something here so that everyone can see it all at the same time, because we had a tremendous head and shoulders pattern back in 2008 when the market broke, and now what we're doing is we're coming down, and we're coming into a potential 61% retracement, down about another 10%. So 10% lower in the gold and silver index, which would take the gold down possibly another 10% down to our 1660 level, would set up a potential really good buying opportunity in the gold silver index, because you'd be making a 61% retracement off of the low from October of 2008. And remember, stocks bottomed in March of 2009, but the XAU bottomed in October of 2008. So that's something to look forward to, but the price is not there yet, and so you still have to be able to look at that when you come into taking for a longer term view of where you should be at that time. Now, someone asked me the timing on when this will all occur. I mean, nobody knows that, and that's the hardest thing to figure out, because there's a potential for this to come all the way down and make a Gartley at 102. In other words, a 30% drop. So we don't really know. We have to wait until the XAU gets down to that 129 level to see if it's going to hold that, and that's all you can do. Because remember, folks, when you're trading, two things are 100% unchangeable. A, you never know how much you're going to make on a trade. You'll never know that. And B, you never know whether the trade is going to win at all or not. So the only thing that you can control is the amount of risk that you have on a trade. So you've got to focus on how much you have at risk and not how much you think you're going to make. And it's a very important concept that a lot of folks, sometimes, don't always, realize that that's the case of, where things are, really are. Now, I need to go to the euro for just a second, because it controls a lot of this, the money that is moving around in these markets, and we want to be able to, to see where we are. We said before that we thought the euro was going to get below the 132 level without too much trouble, and we're already below that level already, and I think we still have some more to go. I believe we'll be down into the 126 level in the euro without too much, because we had that big ABCD Gartley form, and now the first objective has been made. We did make a small ABCD on the hourly basis down at the 130, 150 level, but frankly, I don't think that's going to last very long. But longer term, the euro looks incredibly bearish. If you take a look at the euro, on the weekly basis, which is a price or a chart that is worth the price of admission to TFNN. Let me put that in there and show you that if you go back from 2008, when we made the butterfly top, back in March, you'll notice that we've had several Gartleys. There's been 3 of them, and the last one was just recently. And each of those Gartleys led to at least a 10 or 15% drop in the euro. Now that's the equivalent of around $13,000 or $14,000 per contract. And for long term, the trend is down. We've had lower tops since 2008. We had a lower top in 2009. We had a lower top in 2011, and we've had a lower top in 2013. So this is telling us that the trend in the euro is, certainly, on the downside. Now, we're going to take a look at one of the all-time favorites here in Tiger TV, which is the natural gas contract, and we've been watching that for quite some time. We've got a little bit more to go to the downside before we finally get our pattern to form. And if I can just update this for a second, I will. Okay, we're ready to go, and you'll see that we did make a little ABCD, but we are still heading for the 2.73 cubic feet in the natural gas. In my opinion, it looks like we're about halfway through this, and we should be able to see that it's going. We talked about crude oil, of course. Crude oil has been a very, very interesting thing to watch, and we've had a huge break in crude recently. We had the Gartley form on the daily basis that we looked at up at the $98 per barrel level, and now we're breaking down to taking out the lows of January right now. So my assumption is that we're going to make a 61% retracement at least in crude oil, and that would take us down to about $86 a barrel. Now remember, we dropped $2 a barrel on Wednesday and $2 a barrel today. So $2 a barrel each day. We could be there by by Wednesday of next week. We could be setting at that $88 per barrel level without any trouble at all. But at least the trend is starting to move down from the Gartley pattern, and that tells us that it is beginning to look like it's made a real serious Gartley pattern, and looks like it's got a long way to go. So the exact 61% that I'm looking at, to be exact, would coming in at just about $88.50 a barrel. That would be the the kind of thing that you'll be looking at. Now I want to bring out the fact of we want to look at Brent North Sea crude, because there's been such a change in that one compared to the I got to make sure I get this right, because it's got here we go. Yes, there we go. We did this before, and we posted the ratios between the two, and you'll be able to see that there's been a huge difference in these contracts, because the Brent has finally caught up with the crude, and you'll see the relationship, because evidently the Brent North Sea crude is a better quality oil. I don't know why they call West Texas sweet crude. I don't know, but there was a huge premium between the Brent North Sea crude and the crude oil itself. Now you can see that because the Brent made a beautiful butterfly pattern up at the 116 level. It missed it by 30 cents. That's 30 cents in a contract worth, that's $300. It's worth about $116,000, and now has broken down over $3,000. We've got to take a little break here, and when we get back, we'll finish up the show with some more information. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, folks, we're back, and we have a call from Vince in New Jersey. Are you there, Vince?
I am, Larry. Good to talk to you.
It's good to hear your voice, my friend. How are you?
Well, I'm better now.
Good. Glad to hear that. What can I do for you?
SDS, I know you're talking futures, but I haven't been able, as I said, I'm in a rehab center. Came down with pneumonia, and we just want to, say hello, talk to you, and find out what your take is on Donald Sam.
Okay, this is the double ultra-weighted short E-mini or S&P. And, we've had a strong day yesterday, and then we gapped up today, which could be quite significant. The thing to watch, Vince, is the last time we had the big rally in September that lasted to November, the market went from, $51 a share to $61 a share. It rallied $10, and then the next time it only rallied $5. And we've already rallied, $3 in 2 days. That's a real positive sign. So I'm assuming we're going to get about a $10 run, just like we did from September to November, and that would take it up to probably the 61% retracement of that high from the solar eclipse and new moon of November the 15th. That would take it up at around the $57 level would be my guess. So, the way it's acting, given the fact of what the VIX index has done and the way the commodities are falling apart, I would think that the that level would be, very attainable.
Interesting. How have you been, Larry?
I'm okay. I'm kind of worried about you, though. That pneumonia is not a good thing at your age, my friend, so make sure you take good care of yourself and don't go outside. It's pretty cold out there.
Well, my wife didn't fool around. She called a doctor and she called an ambulance.
That's good. I'm glad of that. Just take care of yourself and you'll bounce back good. We had a blizzard here yesterday, Vince. They had to cancel the Tiger Woods Accenture golf tournament, the match play tournament. They're going to try to play it today. It's the snow's melting rapidly, but we had a huge blizzard with snowflakes as large as I've seen, and it was really quite spectacular. I posted a chart into Tiger TV this morning to show the folks what the mountains behind the house look like. So it's the weather's crazy all over, that's for sure.
I think God is angry with us.
All right, well, that's for sure, but we'll keep you in our prayers, Vince, and call in once in a while. Let us know you're okay, all right?
Well, I'm due to go home in a couple of weeks, and you'll be hearing from me at that time from time to time.
Wow, that's great. I'm glad to hear that. Well, have a good recovery, my friend, and we'll be able to talk to you soon.
Thank you, Larry, and God bless.
Okay, my friend. Someone's asked for a question. Asked us to put the picture of the snowstorm back into the Tiger TV, and I'm going to. And you'll get an idea of, what it looks like in Tucson and the mountains behind the house. Those are the Santa Rita or Santa Catalina Mountains. Behind that mountain where the clouds are is Mount Lemmon, and it's about 11,000 feet, and they have skiing up there from December through March, and you can't even get up there now because there's just too much snow. So anyway, that's it. I believe the thing to watch, folks, is to watch the bond market. We really need it to have a really good rally, and if we can get this rally in bonds up to the 147, 148 level, that would be an ideal, situation for us if it can do that. That's the main thing that we're trying to look at. Gold, we still believe we're going to be looking at much lower prices. We'll probably get some good rallies through here, but we'll see. This is it. Live every day in an attitude of gratitude, and may God bless, and we'll see you on Monday.